The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
On-chain analytics firm Nansen has released an in-depth report on the trading activity that led to the now notorious depegging of the stablecoin TerraUSD, more commonly known as USD, more commonly known as UST. Nansen's most important conclusion here is that there was no one single attacker that brought down UST, but I will let them get into the report in more detail. Joining us now is Aurelie Barthere, Principal Research Analyst at Nansen. Welcome.
Hi.
So, Great to have you here and great to have this very detailed report. Before we get into the nuances of the report, I love the sort of 5,000-foot view of, what was the big takeaway of this report for people who haven't been following this carefully? What was your big takeaway and sort of why does it matter?
Mm-hmm. Yeah, so maybe if we start by why does this matter to go through the story again after it has taken place? First, it was really important to highlight the vulnerabilities of the system and why the system failed, and precisely on-chain how it failed as a learning for future protocols, for future stablecoin systems, etc. So that's the why. And what are the main conclusions? The main conclusions are on-chain data confirmed the Twitter narrative that the depeg originated on the Curve protocol on Ethereum. As early as May 7th, it started around quarter to 10 p.m. on May 7th. And as you said, the other conclusion, apart from the Curve origin, was that we had a very limited number of players really instigating the depeg. Those were most likely institutional players, so that refutes the narrative of one attacker. So that's another conclusion on the depeg. And those players were prepared. So we found some withdrawal from Anchor on Terra as early as April 2022.
Okay, thank you. And I guess what I mean when I say why does it matter, I mean, what does this conclusion tell us about algorithmic stablecoins that we might not have already known? Like, what is the takeaway here in terms of, because this has raised a lot of questions about, are these secure, are these trustworthy? What was your main takeaway?
So my main takeaway is the following. Analyzing the Curve flows on the night of the May 7th, the most swapped stablecoin versus USD was USDC. So it seems to confirm that in turbulent macro or market conditions, which stablecoins are safe haven. So that kind of defends the thesis of let's say, non-algo stablecoins and stablecoins that are backed by some form of assets close to T-bills as really a safe haven value. So that was one conclusion of the report.
So let's step back a bit, and this kind of goes to Emily's question, but more of the narrative of what happened. Exactly, how did it all start? You had these 6 or 7 major players. What were they doing prior to the collapse? What they were investing in the Anchor protocol. They were collecting that 20% yield. But what happened? Like, let's start from the beginning and sort of tell the story as if you're telling somebody who maybe isn't quite familiar with some of the nuances of these protocols. What is it? What happened from the beginning to the ultimate decline of UST?
Okay, if we take a chronological order, that's easier to follow. It started on Anchor, as you said, so there were some entities having a significant amount, 20, 50, hundreds of millions on Anchor. And we started to see withdrawals from Anchor very early as April 2022. Sizable withdrawals from USD.
Well, let's start with there, because what would have caused that withdrawal? Why were they running out of, they were collecting a lot of money, 20% yields. So why did they start to withdraw from that Anchor protocol?
And we are seeing the chart on the withdrawals from Anchor there.
Mm-hmm.
Yeah, what caused them to start to get nervous about it?
So So this is speculation also. The data wouldn't really tell us that, but my assumption is that we were in very fragile market conditions. And we know that Anchor offered really an important yield, and the counterparty of that, what is the risk? So if you're a sophisticated player, which the report shows, those players were institutional or sophisticated, you have the risk in mind, in the sense that in turbulent macro conditions, I would imagine if I was kind of a portfolio manager there or trader, I would start slowly reducing the risk. So that's just speculation.
Right. So they start to take their money out of the Anchor protocol. Then what happens? Because this is sort of when things start to get shaky, correct?
And we do know that, who are some of the biggest players that took out money? Because we do know that, I believe, Celsius took about $500 million worth out of Anchor protocol. Are there others, and is this verified with the data you've been reading on chain?
Mm-hmm. Yeah, so we have other wallets, but unfortunately we couldn't really label them as we did with Celsius. We have other names, so there is HS027.ETH. There is this big wallet, the one that has withdrawn 85 million from Curve, also starting very early to withdraw from Anchor. So we couldn't really label this wallet. We have some clues around this wallet, but we don't really have a definite label around that. We have some other wallets that are interacting with other funds. We have Alpha Finance also as a wallet interacting with one of those wallets. So we have some labels, but what we do know is that the wallets that swapped in Curve later on are the one that initiated the largest withdrawals in April/May in Anchor.
So kind of let's get to that, because you're saying they withdraw their funds from Anchor. Then what happens? Like what precipitates the fall of USDT and Luna? How does this kind of, for the average person watching this, and they're already almost lost a little bit here. But let's get back to they take the money out of Anchor. Then what?
Okay, so that people are not lost. Okay, chronologically, we're on Terra blockchain. There's a protocol, Anchor, giving you 20% yield. The market, let's assume the market is shaky. There are some withdrawals, significant withdrawals by a few amounts of wallets. It's April, May. So now we arrive at May 7 when it all started, and we are on Ethereum. So what happened is that, how did we come from Anchor and Terra to Ethereum? On May 7th, we started to see a spike of May 7th and May 8th, a spike of bridging. So meaning going from one blockchain to another blockchain. So from Terra, these funds that were withdrawn from Anchor moved to Ethereum via the bridge, and straight away started to interact with the so-called Curve liquidity protocol on Ethereum.
What were they doing in that process? They take their funds out of Terra, they put it into Ethereum, they put it into the Curve protocol, and so that's USDT that they're doing that, correct? And they're swapping it for USDC. Is that what's going on, or what's happening here?
So they took UST. So the stablecoin from Terra is UST. So they moved it to Ethereum, and then on Curve, what you can do is you can swap UST for alternative stablecoins. And they started to swap mostly versus USDC, so the stablecoin from Circle, which is different from UST. So they just took the UST fund to Ethereum, send it to the Curve pool, and because this Curve pool allow you to swap versus other stablecoin, they started swapping their UST for mostly USDC. But later on, we also saw swapping with, as you were mentioning, Terra, USDT, and also DAI. But the biggest chunk was USDC.
And so that floods the market, correct? I'm sorry. So I just want to just be clear that's flooding the market with Terra, with USDT, with UST. It's flooding the market, and so the price goes down, correct? And that's what ultimately started to bring the UST price down.
That's correct. So that's created the imbalance in the Curve pool. Too much UST, not enough USDC. and then the market was flooded, and then they started to depeg. You can actually see it if you look at the curve at the price chart of UST, just a candle chart intraday on your guys' dashboards. You can see this first leg where the curve protocol was being challenged is really the night of the May 7th from 15 to 10 UTC PM until early in the morning of the 8th of May.
I think the question a lot of people are asking is, could anything have been done to prevent this? Was this just something that, is there anything about the structure, or I'm just curious, like from your reading out, or is this just something that, with any algorithmic stablecoin, they're just vulnerable to these kind of shocks, or could something have been done to prevent this kind of outcome?
Yeah, that's a great question. I mean, no, we're just speculating, and we would need to do another analysis with stress test and simulation. But what could have potentially changed that is the depth of the liquidity pool of curve, meaning if there is enough liquidity to allow for this swapping, that could have led to a different outcome. So yeah, having let's say more liquidity, allowing you to swap this algo stablecoin versus a more traditional stablecoin backed one-on-one by assets.
One criticism was that you had LFG, the Luna Foundation Guard, with a lot of Bitcoin, and supposedly that Bitcoin was supposed to shore up the reserves of UST/Luna, etc. And it didn't seem to work in this situation. Why didn't it work? Or did they deploy it correctly? Did they deploy it at all? Do we know anything about what they did with that Bitcoin to try and stop this death spiral?
Yeah, so unfortunately we didn't cover that part, so I won't give you an answer on that. It's just that in terms of death spiral, you put your finger on it. So in a sense, once the supply of Luna became very, very strong, just parabolic, then there's not much you can do. And we have experience in traditional markets with what can happen when the issuance goes too fast. It's not possible to stop it. Just the Luna supply was growing too fast. That's my reading, but we didn't cover really this part, the use of BTC reserves in this report.